That music is so good. I don't want to start the show.
How's it going, Jack?
Doing good. How are you doing?
I'm bringing in some premium like crazy. I sent you
Yeah,
a
you showed me that. You got to walk me through that one and a couple of others.
absolutely, absolutely. How's everybody doing today? Let us know in the chat if this is your first time coming or if you're a long time listener, first time chatter. Well, you get down there in Florida, Mrs. Jack has you wearing glasses and
Oh, gee, we were out on the beach late last night, and I don't know, my contacts just went crazy. So I'm giving my eyes a break.
This, my friend, has some serious premium.
Yeah, I know. I sold the 20 strike put and got two bones.
Look at this though, just for next week.
Yeah.
You can sell right now. I just rolled a 1950 just before I came live. Got a dollar credit going from this, from tomorrow at 33 cents out to next week. Whew, dollar credit.
Yeah. And you brought in almost 2 grand in a week.
Well, that was a bigger position I rolled in my retirement account. I have 19 of these that I rolled forward for a week. Brought in basically 2 grand of premium, getting a dollar per contract just to go out one more week.
Freedom wants you to explain the role. Let's show everybody exactly how you did it.
Exactly.
Now,
We
you got
buy
to
this
remember,
one.
folks, we put our own money on the line here. We're not just talking the talk. We walk the walk. So when we got to trade, just know we did it.
Here's the roll. You would buy. Yeah, you had to have a short put to begin with. I had because I just rolled it. I had a short 1950 put for tomorrow. Tomorrow's expiration still has 36 cents on it, which is pretty ridiculous. But
It is.
I went ahead and bought this back because this was too juicy to let slip away. A dollar premium to add one more week to it.
Wow.
Why? Because earnings is coming up next week on the 22nd.
Huh.
I'm capturing the earnings play. The premium's juicy. But this roll, you would buy back this one and you would sell next Fridays in one single order. That's what it means. Now, if you don't have a put existing, like you haven't gotten into this trade, you could get into it by just selling this week and collecting a dollar, potentially up to $1.50 right there.
And that
On the
initial trade, folks, is just a sell to open put.
If you give me 1 second, make sure I'm in the right account here. I could potentially do one of these right now while we're
Yeah.
sitting here. $1.50, create the order. You would be tying up. I would be tying up 1,800 bucks in this account, getting paid instantly 150 bucks
Ooh.
for 1 week, eight
Uh,
days. Now the commitment, I'm committed to buying this leveraged Tesla ticker with 2x leverage. It will cost me 1,800 bucks out of pocket, even though it's the 1950 strike, because I'm getting paid $1.50 to get into it. My risk is that right there, 1,800 bucks.
Yep. That's your risk, and you're getting paid 150 just to make a promise. Conditional order. So he's saying, I'll buy it, but only if it goes here. And what's crazy is you get paid to make the promise.
And we'll see. I'm not getting filled exactly at $1.50. I can walk it down just a little bit. That's what we call walking down. You roll down the price, give up maybe $3 here, and I got filled right there.
Beautiful.
So $1.47 was my cost, or what I got paid. $1.47. So 147 bucks I just got paid to get into that trade.
And the strike,
1950.
you like that strike on this. You've been
Yeah.
killing it with this. So
Well,
you're
it's been,
taking the same strike. You're not raising the strike. You're just rolling out really time.
well, look where it's been sitting.
Yeah.
It's been sitting right there for a month. Just grind away that premium right there.
Grinding, time decay kicking in big time.
I've been making tons of money just sitting on that 1950, 20. I've actually got 1950s, 2050s, 2150s because that's where it's been trading for a month.
Yep. I'm out to 20. I might add a little bit to that for next week.
So I've been
I think mine
just been
expires tomorrow.
just been playing right there because there's so much premium. I mean, it's been so much premium. You know, there's even still premium, like I said, if you just want to risk it to tomorrow, you still get $35 for a day. You could go down 50 cents, you know. Well, this thing's it'd be 80, you go down 86 cents. You still get $20.
So, Tamara, we're talking naked puts here.
Yeah, this is a naked put. But you know, it's cash secured is what it is. You know, I'm taking my $1,800 and securing this, you know, backstopping this short put right here. You can see I have some 20, I have a 320s and now one 1950 in this account. Out to next week.
What's tomorrow's 20 looking like?
Tomorrow's 20.
I
That would
might have to roll
be
that out here myself.
that'd be roughly
Yeah.
50, you know, 60 cents, you know, almost 58 cents, something like that, 57 cents.
I sold it for 2 bones. If I bought it back, that wouldn't be a bad. I'm gonna maybe roll that one out too.
It's just, I mean, and next week's 20. I mean, it's still sitting right at, you know, $1.70.
Wow. Pretty
So
juicy.
this is, you know, this is not universal. Now, a lot of people like to think that, hey, they're playing a leverage ticker on Tesla. That means all leverage tickers are great. False. That's a misconception right here. Look at the number of contracts that are being traded on this ticker right here on both sides. This is traded as much as Tesla is traded because it is Tesla. This is riding on the back of Tesla, but with way cheaper options that proportionally have more premium. Now, I walked through an exercise this morning on my live stream that I don't know if it's going to work out or not, but let's check this out, Jack.
Now, one other
Um,
important thing before you leave that is the capital requirement to do a naked put on TSLL is a fraction of what it would cost to do on Tesla, capital requirement wise. So just remember that too.
yeah, I mean, look at this. If you're going to trade 100 shares on Tesla, we're talking about $43,000 to get involved right now. That's how much it's going to tie up. To do a minimum size on TSLL, we're talking about tying up $1,900, $1,800 when I sold the put. That's much more affordable for me than I'd much rather dial in $1,900 of risk than $43,000 of risk.
Mm-hmm.
That's my point in my life. I don't have big $43,000 chunks to just throw around. So this is where I'm playing. I think a lot of people are agreeing with me. Now I want to go back and illustrate something here. Tesla. You know, we talk about what is the market maker pricing in as far as move goes. $37 right there. $37 move on Tesla is what's being priced in. So let's bring over the handy dandy calculator. $37. We'll just round down for all intents and purposes. Divide by, you know, we're right at 435. So we'll divide by 435. You know, it's going to be basically the same whether which one we're at. So that's an 8%, 8.5% move is what that says right there. You know, just in case anybody's having trouble with it, times 100, that's 8.5% move right there. 8.5. So when we go to TSLL, what are they pricing in for the move here? I found this to be really interesting. TSLL moves 2x Tesla. So this 8.5, you would multiply that by 2. So you'd be talking about a 17% move should be priced into this right here. We've got $3.30 divided by 1984. And they're pricing in slightly bigger than a 16, not quite a $17 move, but they're pricing in very similar move into these options with the 2x leverage. Now, what I found interesting this morning, that's why there's so much juice here, is because they're pricing in that bigger move. And that's why you can actually get paid better trading this one than you can trading Tesla itself. Is the risk elevated because it's a 2x leverage? Absolutely. That's why it's risk $1,900, not risk $43,000.
Good point.
Now, I want to show you something. I mentioned this UVXY trade about a month ago, and I actually cashed it out on Friday when we had that big drop after I was off of here, so I didn't get a chance to mention it. Monday, of course, we had the big launch we did on Sunday, so I didn't remember to talk about it on Monday. But I want to show you something. Looking out on VIX right here, the move that's priced in for November. We talked about that we'd possibly roll out or look at adding more exposure to November's expiration as we got to the October expiration. Well, October expiration is tomorrow, so now I'm looking out here to November, and VIX right now, if you go at the money, which it moved since I was live this morning, we're looking at $5.60 move right here. It's almost the same. You could sell any of these at the monies, and it kind of roughly the same. 520. Come right here, 530, 560. That's all roughly in the same ballpark. Few cents difference. So looking at that at the money, roughly 560 divided by the price, which is right now 2140. They're pricing in a 26% move.
That's a little steep.
26% move. Wait, there's more.
Well, they're pricing and they're making it. You'd be unable to make any money off that option. They're taking they're taking all the money out of it already for you.
So that's got to go to 27 basically just to break even, pretty much, right there. If you were non-directional. Now this does have some directional bias to it, priced in, but that's interesting. Oh, I typed it out of order. UVXY. Looking at the November right here. This is where it gets kind of crazy. So 2 times 26 would be 52% move, which is what should be priced in here. Right? So it should be priced in. Let's go. We're closer to 12 right now. 415. I just lost my calculator button. There it is. 415, which, think about that. VIX itself was only 560. This is priced at 415. But we divide by 12. That's only a 34% move type priced into here. But VIX itself has a 26% move. And this is 2x leverage on VIX. So this is actually underpriced. So where's the better place to play? VIX or UVXY? UVXY is the better place to play because they're underpricing the move.
It's mispriced, really.
Yeah, they've mispriced the move. This is opportunity. This is how you make money in the market. You find something that's underpriced and you take advantage of it. Now, how would I take advantage of this? Probably going to buy a call option up here within the, VIX is pricing at a 50% move. And this, VIX is pricing at a 26% move. This would be a 2x leverage, so it would be a 50% move. So I need to play something that would be less than a 50% move because it's only pricing in a 34% move. All All right. So I could buy anything down here below, say 18 is the potential for where it might move to. I look at, if I played a 17, I'd need a bigger move than 18 to get paid, really. If I buy a 16, so the sweet spot is probably right in here around 14, 15, if you're going to buy a long call option. Now, if you're going to do a spread, this is where things get interesting, because you could do, I'm not saying you should do this. I might do this. I might not do this. But you could buy a 14. We're talking about 18 being priced into the VIX. So you could come up here and sell 18, or you could even sell one higher. Now you're at a 76 cents cost with a giant upside potential, $5. So you're risking one to make like 7.5.
Yeah, that's great.
That's a good risk to reward
And
for,
it's a low entry, right?
yeah, low entry fee at 76 bucks per contract.
Super low. Lottery ticket
Yeah, it's a
with
lottery ticket.
with better, maybe a little bit better probability than a lottery ticket. But who knows? You got to be willing to risk 100% of it.
Yeah, this could go to zero. It absolutely can go to zero. So
Anytime you do an option trade, it's got to be with money you can't afford to lose because it's high risk stuff. But if you turn it around in your favor, uh, taking advantage of debit spreads, credit spreads, naked puts, covered calls, you can bring in a lot of cash flow, and that's what we're doing here.
now some people, have asked me, well, could you finance this with a maybe a some sort of put credit spread on the other side? And you could. You can see if you do a put credit spread here, 10, 7, 3 wide, you could get this thing down to like 8 cents. Now, the risk is it goes down against you and you lose 300 bucks. But the upside here, you'd be risking 8 bucks to potentially make 500 bucks. Now, it's actually, the risk is 300 plus 8. So 308 to make 500. And that all of a sudden doesn't sound as good as just risking 76 bucks to potentially make 7.5 times your money.
Yeah, much better.
So while you
You're
could
looking
reduce
for
your
victory.
cost, you're not really reducing your risk. And that's the caveat that like a lot of people don't dive into and think about. And for those of you that are visual type people, let me log into another platform and actually graph this out for you. Log into my E-Trade account that can draw this up really pretty. Let's dive into UVXY. Pull it over here. We can all see it. There's the November expiration. They don't, how do you know which one's the monthly? They color it a different color and don't put the day on the normal monthly. And we were talking about buying a 14, selling a 19, right? 76, 77 cents. Here's what this looks like. We got to be right. It's got to go in our direction. VIX has to pop. UVXY has to pop with it. And our risk, at the current price of 78, 1.1 to 5.4. We go look at 76, it was a second ago. Yeah, we're like 1.58 to 1. So risk 1, make 5.8. Didn't do my math quite right in my head. Now, let's say we add the put spread to it to kind of finance this thing, right? We were talking about like a 10 and buying a 7. 7, not 6. And we're doing puts. Take it a second to update here, I'm sure. November. There's no liquidity on the 7. Let's just go with the 8, $2. So now we're down to a cost of 15. But look what our risk reward did. It went to 1 to 2.26. So if this goes against us, we're in trouble. Now it
Now,
is possible.
for the credit spread, you don't need the stock to go up. but for the debit spread, you do.
Yeah, if we were to boost it just a little bit, actually get into a net credit situation. Now we've got some, we'll make money all the way in here. We finance this spread. If it goes down, though, we lose money. We have some downside protection down to the break even's roughly 1060. So we got some downside protection at 1060. If we get any kind of volatility event, we should be in the money. The max profit, 537. The risk is right now 1 to 2. Now, if you're trying to insure a portfolio, a risk of 1 to 2 is not that great compared to if we remove these options off here. Right there, just went with the call spread, the call debit spread, where we spent 76, 77 cents. Now this is more like insurance. You spend $1 to make 5.6. That's a much better risk to reward for insurance than 1 to 2.
And you don't really need to finance that trade because the entry cost is so low.
Yeah, and the entry cost is low. So that's...
You don't need the debit spread. I mean, the credit spread part.
So it just, I'm trying to help people understand, Jack.
Yeah, no, I know. That was a great analysis of the whole thing.
A lot of people like to well, what if I added a credit spread? And what if so you're actually eating away your potential profit by doing the credit spread.
You are. Yeah, you're putting more capital at risk also into that trade.
Yeah,
whereas here, it's the biggest bang for your buck.
That's what a lot of people don't necessarily realize. They're like, oh, it looks like my income goes way up. But at the same time, it did go up. But at the same time, it ate away your risk to reward, which if things go against you, which, let's be honest, we don't always get everything right. Sometimes it might go against you. So if maybe it went against you, your risk reward was skewed on something that should be insurance for the market melting down. But you just open yourself up for more risk instead of taking on less risk for more upside. All right. So anybody finding this beneficial, let us know in the chat right now.
Yeah. Great explanations, Maggie says. Yeah. They're liking it.
All right. Good.
Yeah. Let me update you on something I don't think I had a chance to tell you. But Tuesday, I sold Rigetti short.
You actually did that, huh?
Yeah. I couldn't help myself. Now, I probably not. This is probably not going to work because it goes against everything I've ever done. I use a market-driven approach, which means I don't short stocks in a bull market. But this thing is running on fumes. So it's going to really get my attention at 44. But
not far away.
We got to ask the crowd. Now, yesterday I asked them, and I'll tell you what the answer was, the most popular yesterday, but let's do it again. So should I add to this short, reel it in, or let it ride? What do you think, Jeffrey? I'm out at 57.04.
I mean, I've shorted stock a whole 2 times in my 30 years of trading. So I will buy puts because it's limited risk. I do not short stock. I don't. So
All right.
For me, I'm out. Like I'm
not me. Let it ride is the winner. Steve says close it. I'm not going to close it, my man. This thing is on fumes. So it just got my attention because that angle, if you go down there from when it was 15 to where it is now, that's not sustainable. Take some profit if you can, Dennis. That would be good. Take half the profit. Kay says add. Yeah, I'm more tempted to add. Now, using your view, your lens, Jeffrey, where do you see this moving to in the next?
Hold on 1 second. I was trying to type out this trade I just broke down for everybody. This is the optimal trade that we found out of that analysis for risk to reward was the buy a 14 strike November 21, 2025 call on UVXY, sell a 19 strike November 21, 2025 call against it. It's a debit spread. to take advantage of the risk one to make 5.6
And the
potential.
limit on the debit is 76, 77, 78 cents. You might have to adjust it a little bit, but it was
Yeah,
right at 76 there, you saw. So that's 76 bucks to get in, and
and
you're risking
debit
100%.
tuner.
Yeah, and you're risking 100% of it.
All right. Does that help everybody? Typed it out from the chat for you.
Yeah, it helps me. I'm going to put that one on here in a second too.
I don't have it on yet, but I'll give everybody a chance to get on before I put on it. Quite honestly, looking at this, here's my technical analysis pattern right here. This is the high.
Do I want to see it?
Here's the low. Here's the high. Here's the low right there.
Yeah.
Here's the fib line. And we already exceeded where this was 75% likely to get hit. We hit it right there. This was 70% likely to get hit. We hit it right there. Kind of found a little support there even when we poked through. This is only 35% likely to get hit. We ripped on through that one. This one drops down to like 15% to get hit without coming back to this line right here. Odds are, Jack, 95% that we're going to come all the way back down here without making it to this.
That's what I'm thinking, dog.
I guess it's 85%. 85, excuse me, 85. I
No,
can't do my own math. 85%.
I don't have those Fibonacci levels, but just after 40 years of looking at charts, you know, that kind of kicked in. You got to trust your gut sometimes too, I think. That's what I do.
And I have one
Ooh,
other.
you're letting the air out of it today.
I have one other trick up my sleeve that we can look at too. We are beyond 3 standard deviations away from my technical pattern, and we have been for well over a month. That's usually an invitation to come all the way back down.
So you're saying there's a 95% probability it can hit 29
I
or
was saying
22?
85% that it'll come all the way back down here around 19.
Wow.
Yeah,
That's
15%
extreme.
chance we'll go on up and tag this level right here,
Yeah.
but 85% likely to come back down here
I
based
could
on my
use it.
technical pattern that I've followed for years.
I could use it. Mrs. Jack already started Christmas shopping, so I'm in deep trouble. Yeah, I like it. I like that kind of action, you know. Stocks fall a lot faster than they go up. Again, when you short a stock, you got to be willing to risk all of it and more because if it goes up, you're going to have to buy it back to cut your loss, and that's going to cost you more than you might realize if it gets ripping.
Now we're talking about a drop all the way down here. Yeah, I was talking about a drop all the way back down in here. And there are potentially plenty of opportunity you could do with puts without shorting the stock. So we can talk about some of that too if you wanted to, Jack.
Yeah, yeah, lay it on them. I just think this is you know, from just an old trader's eye, that looked like a great short. And I don't know how much further it has to fall, but I'm going to let it ride just so everybody knows. I'm not going to reel this in.
Now let's just look at a few scenarios here. Like, whew, these are pricey.
I'm telling you,
These are pricey.
losing money, not even a tiny bit of earnings. No application for their product.
And no prospects of having a product for a
Nope.
while.
Alphabet and IBM are going to dominate quantum if it comes out.
Now, the market makers aren't dumb, everybody. You got smart people like Jack that do this, and then they've programmed all their smarts into computers that react faster. And
Oh,
this thing is priced for
ooh.
downside. I'll just looking at an option chain right here. This is only out 36 days. This thing is priced for at least a $10 drop. And if you look at the monies here, Yeah, they're pricing in a $20 move. They're
Wow.
saying we're not going to lose money in basically an $18 and
That's
50
what they're
cent move.
that's what they're saying. They're saying they're not saying we expect it to do this. We're saying we're going to insure ourselves up to $20 move because they don't want to lose money and they know they'll get their head ripped off if they don't have this thing priced right where they can afford to sell it at a super high price and have a chance to buy it back. They don't want to be short these options. And if they
That's
are, they want to be short them at a stupid high price.
the one standard deviation move right now is priced down to 22, and the 2 standard deviation move is 0 that the options are pricing in.
All right. So if you were just new to this idea of taking advantage of spaghetti going down, which goes against everything I ever preach, but I did it anyway, how would you play it or would you even still play it?
My way to play would be to buy a put that would cost me about $1. This is the
Ooh.
way I usually play these. If I'm
But-
if I'm really sure. Now this gets me way down and I'm going to need a giant move. And when we're talking about only going to 20, that's only a 5 to 1 payout right there.
Okay, so you're going to use a debit spread.
Well, I mean, I would just I like to risk $1 on these usually when I'm gonna
Okay.
play.
So you're just going to straight up buy the put.
I would just straight up buy a put right there around 25 is what I would usually do.
I wish
And
I wish this thing had a two-time ETF.
I bet
I'd be
it does.
pounding
Let's,
I'd be
let's,
pounding it like a
let's go look at that in a second.
I'd be pounding it like
Now this is actually more compelling. Buying a 30 put and selling a 23. That's a 6 to 1 risk to reward right here.
there you go.
That's even better than buying the long put. Now this is why you have to investigate, everybody. RGTI, let's graph it out.
Dennis says bear call spread. That would also be good, but the bear call wouldn't it'd be more probable, but it wouldn't pay out as much.
Yeah, you're not going to get a
Whereas
7 to 1 on a bear call spread.
no. So this has more risk also. The bear call, you could set that up with very little risk. This here, we're obviously trying to hit a home run, 4 to 1 or more, home run, baby, and that's what it is. But again, the allocation of capital is going to be tinier than something like I do on Nvidia, and that's how you want to set it up.
Now, Jack's max loss selling shares is how much, Jack?
About 7%
And that's with a stop, right?
on the stock, not never on an option, just to be clear.
Yeah, but that's just you have that much risk, and you have to have a stop. You have to stop out yourself. If it stopped trading and gapped up crazy high, what's your risk?
7% max.
Are you sure? Even if the market was closed and it gapped up $100?
Well, I have unlimited risk.
Yeah, that's my point.
Technically, the broker's going to tell me I have unlimited risk of a
Right.
short. Yeah.
Unlimited risk. So right now, looking at
And,
this,
and the reason that is, let's just clarify that's a really good point. Like I can put a stop on the stock either way, long or short, but that does not mean you're going to get filled at that price. And the reason you would not get filled at the price is the stock would gap when the market's closed and the stock is still trading, it's going to gap open when the market reopens. And if it gaps lower or higher than your stop, you're not going to get filled.
let's
So
say 10 minutes from now, Rigetti stops trading pending news.
Trump buys it.
Yeah, Trump buying it, or maybe, surprise, we actually have a chip that does everything we said it would do.
Ooh,
And we're going to start selling it next week.
to China.
This thing, this thing could pop $100, $200. It closed right here because of news, and it reopens at 250.
And what's old Jackie boy going to do?
You're going to get stopped out probably on a margin call.
Or short more, because that would be
Or short more, yeah.
that would be a ridiculous pop. But that's my risk. When the broker looks at it, that's why they hate shorts. Because most of the time the market goes up. So most of the time guys shorting are wrong. And you got to be really good at it. And even the ones that do it are not even always straight up. Some of these short selling research firms, They'll short a stock, then they'll put out a research report on why it's so bad, hoping you're going to pile on and do the same thing and create their own profit. But that can be a dirty business. But otherwise, you got just a simple, plain, short opportunity staring you right in the face.
Now, this right here is an option play to take advantage of the same thing, but you're capping off your max risk to $98 a contract
Which is much smarter.
with a 1-to-6 payout ratio right here.
Hmm.
So if it's going to burn down to my technical analysis, wild, educated wild guess target, it would pay out 6-to-1 basically.
And what is this option strikes here? Where are you using?
This option is Rigetti, RGTI.
Yeah.
You would sell the November 21, 2025, 23 strike put, and you would buy a November 21st, 2025, 30 strike put on RGTI. It would cost you, right now it's moved up to $1.
That's okay.
Yeah, that's okay. You're still, the risk reward's still right at 1-to-6. A few of you are probably doing that trade right now. If you wait a little bit, the price will come back down a little bit probably.
Yeah. Now remember, goes
The less
against
you,
everything I've ever done. It's not doesn't fit any system. It doesn't fit my style. It's just as an old veteran chart looker at her, this one looked like it was coming back down.
the less you pay here, the better it is. RGTI, you would sell. I'll put the buy in first. Buy a November 21, 2025,
I'm gonna do it too.
30 strike put. You would sell a November 21, 2025, 23 strike put. Cost would be right around, we're going to target 98 cents. And that equals the risk. Right there. Yeah, Jack doesn't usually go negative ever on anything.
What's that?
The comment in the chat, Jack doesn't usually go negative on anything. So
Yeah. No, I know. Yeah.
there you go. That's a potential way to play right there. That is limited time. Jack's short shares have no expiration date. This does have an expiration date right around Thanksgiving in the US. About a month out.
Now, I went it backwards, just so you guys know. A lot of short sellers that are good at it, they start out with the fundamentals and they say, this thing is no good. Whereas I started out with the technicals and saying, does the fundamental situation back up me thinking this is air? And when I look at the fundamentals, they got to report every 3 months. You can't lie about it. There's nothing here. That doesn't mean it won't go higher because this market is crazy. But, you talk about bubbles all the time. I'm hearing more and more and more about bubbles. Quantum, that's a bubble. AI is not a bubble.
AI has some real applicable things and it does make some money.
Already has. This is a
Quantum
bubble.
computing has no hardware, no software, no algorithms, no nothing, just a bunch of theory and hype. That's really all it's got. Theory and hype.
Yep. So I couldn't help myself. This is the old school way we used to do it in the 90s. Yeah. Yeah.
There's no
Hammering
earnings.
stuff.
No earnings right here.
I'm glad your technical view, the lens you look through, confirms my suspicion. But you shed a lot more light on it when you said all the way back to.
Yeah, we could go back to 20. I mean, that's real. Like, that's the breakout too. It just happens to be the same place that we broke out from. That I see that pattern all the time too. Just come retest the breakout. So that's what I see right there as a potential. It's, may not work out. We may all lose money if we try it.
Yeah. No, I'm willing to do it. I'm willing to pile on the stock too.
And I guess I could try to put one on in this. Let's see if I have any buying power in that account. I do have $600 in that account.
That gets you 6.
I am filled at 98 cents for one.
That's good.
Right there. Got the fill. You can see I'm up. a whopping 2,600 bucks in this account with a $12,000 live
You know,
brokerage account here. So
so ironic that, when I was trading with Lance, I bought this Rigetti at $3.33, just on a pure lark. I got a speculative account when I only try to hit a grand slam home run. And so I bought it at 333 and I sold it right exactly at 12. And I thought I was a genius. And the other day, this thing kept popping up on a screen I look at, and I just thought this can't be real. That was when it was at 44, and then when I saw it at 57, I'm on it like stink on a monkey.
and it's just going. This market is just going. Everything's getting stuff pumped into it. So
Hmm.
eh,
I got an email request to take a look at gold and silver.
gold and silver. Yeah, I mean, gold. Funny enough, gold has a chart looks a lot like this. We can pop it up here. The ETF for gold. Jacket, gold and Bitcoin a lot the same. If you go buy gold, physical gold, you can't cash flow it. Doesn't pay any dividends. Doesn't have any board of anybody. I mean,
Yeah, no, now there's a lot of disadvantages to doing physical gold. I got to just tell you, in 2 minutes or less. There's a guy I know in Florida, and he thinks every time we raise the debt that gold keeps going up. So he goes and buys these bars, and he takes them over to. He's got them in his house, the bars, and he's talking about how he's stockpiling them up. And I'm like, man, you're playing this all wrong. You got the gold part right, but you take those gold bars home, and we have some kind of issue in this country. People aren't going to be the soup line won't be peaceful, right? It'll be riots. No, someone your neighbors know you got that gold bars, man, you're doomed. The other thing is when you go to try to sell the gold, you got to sell it to a broker. He's going to shave you 10%, right? So
or more.
or more. Yeah, and then you put it in the bank or what? I mean, it's physical gold. I don't get it. You're not going to be able to trade gold coins for bread because someone's just going to take them from you if our economy broke down like that. So yeah, I wouldn't take it physically, but this is the way to play it if you want to play it. And then again, options like we just showed you, get a bigger bang for your buck. But look at that. That's not sustainable.
Yeah, I mean that's like a rocket ship. Gravity is going to come into play at some point.
That looks more
What?
like a gold bubble to me than an AI bubble.
This is just, I mean, look at the gaps. Every day, gap, 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 gap.
Somebody
And
said gold is the new Bitcoin.
yeah, that was it. That was in the company chat. And it just what a
Oh yeah,
what a stupid thing to really say. But
really. Well, they'll
um,
tokenize gold and then put it on the blockchain, and then you'll
but
have a
okay,
proxy for gold online.
so how do you not shave a little bit off of that gold bar and create a new gold bar
Gold
if you
mining and Bitcoin mining.
tokenize it a little bit? I'm just saying, like, there's it'd be difficult to tokenize it. I've often thought that was interesting. Tokenizing real world assets. Yeah, yeah. Okay, this bar is minted in Switzerland. It's got a QR code on it that ties it to the blockchain. But how do you know that bar is solid gold and didn't get opened up, hollowed out, put lead back in it, smoothed back up?
The
You know.
tokenization wouldn't have anything to do with the real asset. It would just be like a meme coin, like the Doge coin or whatever that thing is, and
But
trade.
it would have to be tied to a real world asset though to give it any
Well,
intrinsic value.
if it was a stable coin, but
Yeah, there are
I don't
gold
think
stablecoins.
it's gonna the tokenization is gonna make it backed by gold. You can tokenize a house, anything, uh, you know, anything with tokenization, but I don't think it has to be backed like a stable coin does. It
Yeah,
just
I
is
mean,
gonna.
that's where it gets interesting is that there are gold stablecoins and that then there's tokenizations and stuff like that.
Right. Now, the
So it's
stable coin, they got to back it with gold. That's the whole point of it being stable, is that it's stable to the asset. But it's like they tokenized dogs when they came up with that doggy coin thing, right? So It really, it's nothing.
Here's your gold stablecoin right here. Priced in dollars, supposedly tracks gold 1 to 1. So if you wanted to buy gold in the crypto market, there you go. Pax Gold, PXG.
All right. Now let's go back to your lens. And since that's quite frothy, what
Now
do
this is
you,
absolutely frothy. I've been a big proponent that gold was going to break out and go on a big run because, well, we've been working on it for since 2015 here. We had a big run into 2020, and then we got another pullback. We tried to break out. Just look at the technical pattern here. We tried to break out right here, and we got a correction back to the 618 right here. Now we actually did the breakout. We didn't pause at this one. That was the 75% likely target. The 70% likely target was right here. We did briefly pause there. The 35% likely target right here. We didn't even stop there. Now we're down to like 15%, and we just cruised right on through that. We do have higher levels. Getting down to like 10%. This drops out to like 5%. Then we start dropping down to like 1% and less than 1%. And this is like this move would be only like 99, 0.01% would get to this. Is it possible? Sure.
that's a bubble.
But you know what happens after we get to there?
Even lower, maybe. Yeah.
Yeah, it comes all the way back down, usually retest the breakout.
Yeah.
Now, just like we talked about on Reg Betty, this is still likely to come back and retest that breakout. A lot of people don't want to hear that, don't want to think about that, especially if you're long gold, but we could come back to $2,000 an ounce pretty darn quickly. And that's the warning right here.
Yeah. And that's a little bit of a shakeout on gold because, gold's supposed to be safe, a safe asset, I guess, as long as it goes up. But gold doesn't normally go up this much.
We can
You
say, oh, it's a
pop
new
it.
regime. You can, the mainstream media loves to jump on. Think about it. What Jack and I have said over and over and over on the Market Masters here. Whatever's making new highs is where it's the honey. It attracts all the flies, all the bugs, all the, everything goes to what's making new highs. That's the big, shiny, fun, exciting thing. And inevitably, once everybody's sucked in, it's going to be a big pullback. And this last one was 45%. Lasted for 1,500 days.
Now,
This
one
one, the
thing.
smaller one, was at 22% and lasted for 2 years.
Wow.
So if we did 45% again, look, we're right down to the breakout. Right in the vicinity of the breakout there. So
Yeah, Dan says buy high, sell higher. That's my whole thing. Yeah.
but you know what isn't, Jack, we talked about this. The fact that this is just now. If you bought over here on this bubble, you're just now back to scratch.
Yeah, that was the joke is that if you bought it in 2010 or whatever, you're just now breaking even 15 years later.
And you could have cash flowed it maybe if there was any premium. If it had been really tough down here at where it wasn't moving at all at the bottom. Really tough down there in the low double digits.
Vladdy says Jamie Dimon talked about gold. That's a sign of a close correction.
Now,
Jamie Dimon needs to keep his pie hole shut and just run the bank. These statements are freaking people out. Go ahead, man.
silver and gold tend to come into the same kind of ratio, whether that's gold dropping or silver popping. But suppose gold just took a pause and silver caught up. That's the price it would go to technically, right up here. So I feel like that, last summer, I identified gold or silver as the bigger upside potential out of the two. And it still has, this is why it still has that bigger upside potential. Because if it just caught up fib-wise to gold, in the same correction, gold did the same correction. That's 300% upside here, but gold's already up here. So that's why silver potentially has a bigger upside potential. Now, how I would take advantage of that for me, and how I am taking advantage of it, is with a few shares of this, AGQ. Some money bought into this. I'm not buying options. This is a shares play because the upside potential here right now is 600% if silver goes and catches up to gold. So this would be up to like 600, maybe, maybe 700, but that's the opportunity here. Now, what's the time frame? May take a year. I don't know. May go quick. Could be up there next week. That'd be an absolute breathtaking move, and we'd probably come right back down like we did last time. Right up, right back down. This has got a history of going up and coming right back down. Going up and coming right back down. Going up, probably got to come back right back down. That's my warning on silver.
Now, this current run up, you think it's going higher or you think it's pausing? This looks
And,
like it's got to take a breather to me.
I could definitely see taking a breather, but I also could see this shooting because of this long consolidation that took years. I could see us popping right up to here and here really quickly, actually.
Little fear, little FOMO in there.
Yeah, a little, just silver has this like catch up moment where you can see rotation out of gold and into silver really quickly.
Yeah.
And silver's been known to do this. Look at this right here. Brief pause and then kept going. And if you go look at the fib line on that, we don't have much history back here, but this pullback from this high to this low, that was almost to the 200%. We went from the breakout and shot right up, struggled at the 1272, blasted right through the 1618, right up, almost touched the 200. That's exactly the kind of numbers I'm sitting here looking at. We could be right up here in the 150, 160, 180, come up just shy of touching that 200%, and then give it up. This could be what Jack and I have said, the blow off top, where it just doesn't even make sense. And then we come back down. Just like we did here, just like we did here, just like we did. So be careful playing bubbles. Be careful believing things you hear on TV.
Yeah.
I look through hundreds of charts every day looking for this stuff. Whew. There you go.
A lot to it. Bitcoin's taking a breather.
Yeah, Bitcoin. Let's take a look at what's funny, I let myself get called out, Jack, and I told you I was going to take a breather for a little bit. And there was a reason. That move was too big, too fast for me.
Mm-hmm.
And here we are, right back down.
Right on it.
To my technical analysis pattern. I said we might come back down to 60, and here we are, right back down to 60.
Yep. You nailed it.
Right.
I got a 63 naked put still riding, and a 61 too, I think. I got to take a look, but I'm good there.
These gaps in that price, it wasn't sustainable. Like when we go back and, well, we can't see it on this chart. I have to go back on Bitcoin's history chart, all-time history. When we come back and look at where the sustainable moves are, we tend to move up for a couple days, consolidate, move up for a couple days, consolidate. That's usually how Bitcoin moves in its healthy progress. We move up, consolidate, move up. Usually it's two days of run, consolidate for 2-3 days. 2 days of run, consolidate. 2-3 days of run. And we usually do a few of those and then sit there for a little bit. Even in the big run back here, get a few days of run, consolidate. A few days of run, consolidate. That's the way Bitcoin moves. So when it starts making these big day after day after day after day gaps, it's just not sustainable. Like when it's big candle, big candle, big candle, big candle, big candle, big candle, big candle.
Runs
that
out of
gets
gas.
it gets too far too fast, and
Runs,
then we get something like that.
runs out of money.
And right now, this might come all the way back down. It's a caution here because if this completes Elliott wave wise, what I call a 5-wave pattern, that's a warning that this was a major top. And we're starting a new trend, and that new trend is potentially down. So just throwing
Crypto
that out there,
winter.
throwing that out there as a caution.
Yeah. Now, though, automation has really changed trading for me and for you. How
Yeah.
are you using automation currently for
Well,
trades?
I have a variety of automated systems. These little pop-ups that keep popping up down the bottom corner are alerts that I have automatically going out to my members. And recently, this past week, we launched, on Sunday, we launched my newest iteration of automation that just takes everything in my brain, along with my technical analysis pattern, looks at the three most traded indexes out there, SPY, QQQ, and IWM. Let's see if I can load up SPY here in a small time frame. I go with the 2-minute chart on this pattern here, loads it up, and then looks for my technical signature techno pattern bouncing. And right here, there's not really, let me load it up on this one so I can, I've already got it loaded right here on this tab. We turn it on, got to go to the right time frame. And it hunts for this setup. Right there was a bounce, but the entry and exit were all smashed together. So there was no opportunity there. The last one that fired off was on Monday. And that one was a winner. Monday the 13th, right there. This thing just sits here and looks for the opportunities over and over. Now, if you were running this indicator, you'd have to come in here and every time there's a bounce, you'd have to run a fib line, put an alert, keep checking your phone for when the alert's going to fire off. Then you'd have to go to the options market and decide what to do. That's a lot, right?
Too
Like
much work.
how do I know what options to play? I have, the early version of the algorithm, like it even suggested like, hey, here's an option you could buy to do that. But this newest iteration that I created actually takes all of that information and packs it up into an alert with everything you need. You don't have to make a decision on anything really, because it's taken all my best practices of this stuff and packed it up into an alert just like this right here. It
Now,
gives you the option to sell, the option to buy, how much net credit you should get. And then it optimizes the close target, tells you the close target, gives you the risk on the trade. All you have to do is go create the order and put in this is your limit, plus or minus 5 cents. Then whatever you get filled at, you put in the exit for half of that. If you only got 30, put in 15 as your close target. Your risk, right there. And then you just let it cook, as Jack likes to say.
wow. So you took the three most liquid and best to trade assets and you baked them into this.
Yeah. And we found my signature roadmap pattern, the technical pattern here on the 2-minute chart works out a high percentage of the time. Just the last few months, 80% of the time on IWM.
Wow.
SPY,
Wow.
last couple months, 77.89% of the time. QQQ, 80% of the time. Now,
That's amazing.
by selecting the option play that I did, it takes this win rate and jacks it up even further. Jacks it up.
You
No
added a
pun,
piece of
no pun intended, but we
yeah,
added a
yeah, I know.
special type of trade that takes this and leverages it, leverages the ability to have some downside protection and ups that win rate another almost 10%.
Oh. Now that gets my attention. I'm not easily impressed, but this is Very impressive.
Now, Jack and I did a presentation on this several times earlier this week. We're going to do a replay for you. Sarah's going to cue that up right here and give you an opportunity to learn a lot more about how this thing works, what makes it tick, what makes it fire off.
And why automation is so cool going forward.
And how you can get a piece of these alerts as soon as the next one fires off. How's that sound, everybody? Everybody excited? I'm
Yeah,
excited.
me too. I love it.
All right, Sarah, when you're ready, we can fire that off.
All right, just give me one moment here. My screen froze.
It's like that thing of the day. Like mine was freezing.
Let me see.
Already in. Cashbot rocks. Now we didn't get alert yet today. You know, as you can see right here, we can pop this up. There's not. This was a. There was no opportunity there. The entry and exit were the same, and we've been dropping. SPY. Entry and exit the same, and we've been dropping. IWM. No bounce, and we've been dropping. So there you go. It kept us out of trouble. This thing does what it's supposed to do. Right there. And we can keep talking about it for a minute. So for anybody that wondered about that trade I showed off for Monday, let me just pull that over. Pull it back over and we can look at the trade that fired off Monday. It was right up here. It told you sell the October 14th. It's always 1 day to expire. It's not 0 days. Usually it's not day trading. 15% of the trades I've taken have been day trading, but that leaves 85% that aren't. You would sell that one right there. You would buy that one right there, get a 42-cent credit, close at 21. If I go find my close information, we go look at it really quickly. I'll find that screenshot where I closed it out.
Now, the ones that don't fill or get out of in the same day, they're expiring the next day.
Yeah, they all expire. Every trade expires the next day.
Gotcha.
And they're not 0 days. A lot of brokers limit people's ability to trade 0 days. I found my trade right here. Oop. Here was the entry. Here was the exit. I got in 30 cents, got out 11 cents right there. And I actually traded the wrong day. I actually clicked, I mistakenly, because it's been just a crazy week, I mistakenly clicked the same day. I played 0 days. Didn't mean to, but I accidentally did. So I admitted that mistake when I right below it too. Did the wrong day,
Yep.
and I clicked the wrong expiration and strikes sometimes.
Yes.
Can you mess up in a haste to get into a trade? Yeah, you can mess up.
Yes,
Like
you
even a
can.
pro like me can click the wrong button.
Yeah, I've done it several times.
I always hate it when I accidentally, for whatever reason, click puts instead of calls when I'm trying to get in a trade. I'm like, what was I even doing? Asleep at the switch.
Yes.
So